All right, welcome to week 8. We have been building up to this week over the past several weeks, and actually, I've been referencing the content to come in these videos as it has come up in some of the videos before this. However, now we are officially, finally going to discuss the national debt and its importance on economic growth and the sustainability of our growing living standards in the US. So we're going to do this in a four-part series. In this first part, we are going to consider the theoretical case for concern about the national debt. In the next video, we are going to consider the empirical side. Remember, we are social science and economics, and so we need both theory, models, and empirics or data. And so after we look at the empirics, after we look at the data, this is going to lead into another discussion about a heterodox school of economic thought, being that of modern monetary theory. And after we introduce that school of thought, we are going to actually read a book together, or I guess we'll be reading it contemporaneously. And I will have a follow-up video after that reading of the book, which will act as a sort of discussion of the main themes of that book. So without any further ado, let's get started with Debt Week here and move on to consider the cause for concern of the national debt. So it's not going to be a secret. As we get into these videos, you're going to be able to surmise that my position and that of many of my colleagues is that our concern over the national debt, much like that over inflation, is overblown. That yes, there are some theoretical limitations perhaps to the debt, but the way that we treat it in our country politically and economically is more damaging than it is helpful. And so what we are going to consider in this video is the reason why academics, why informed people are concerned about the debt. And I think it's important that you're familiar with this theoretical basis so that, first of all, you can understand how interest rates should respond to changes in government debt, absent monetary policy, and obviously holding all else equal in these extremely simplified models. Now, there are times where those simple models may more accurately describe reality than a more complex model in particular countries, for example. However, in the US, as we'll see, these simple models leave out some crucial ingredients. However, you should be aware what that interest rate response could actually be. I also want you to be able to better speak the same language as deficit hawks speak when they want to cut government safety nets. So maybe towards the end of this video or the next video, we're going to consider the difference between deficit hawks, deficit doves, and deficit owls. So 3 different types of birds, and you can kind of pick where you fall on that spectrum. Deficit hawks are those which are most aggressive in their treatment of the national debt. And so oftentimes, because we can either cut taxes, we can either, raise taxes or cut spending to lower our financial deficits, to lower our national debt. Deficit hawks are often aggressive in terms of wanting to cut government safety nets such as food stamps, housing assistance, welfare, really the support for the most vulnerable. And so if you think that those safety net programs are important, then I want you to be able to be in a position where you can be able to engage in conversation with those who want to cut them and explain to know where they're coming from on a theoretical basis. Also, it is an end goal of this class for you to be able to understand the theoretical basis for the concern over the national debt. As we've moved into some of these macroeconomic concepts, the main question at the beginning of the video is actually what I want you to be able to take away from it. Some of the earlier videos were building up to bigger points, but these last videos, these are all big points in and of themselves. So as you may have noticed in the reading, in 1995, the United States federal government was only 1 Senate vote away from initiating an amendment to the Constitution, which would have required a perpetually balanced federal budget. This means that year over year, every single year, the amount that we spent in government spending would have needed to have been offset by how much we collect in tax revenue. this would have absolutely handcuffed us. As a federal government who can print their own money, this would have meant that we would not have had any fiscal policy option to fight a recession. We wouldn't have been able to raise taxes to fight inflation. I guess we would have been able to do that, but we wouldn't have been able to fight a recession. So really it has to do with growing the economy and helping the unemployment rate not skyrocket. So even most conservative economists recognize that some degree of stimulus, and remember, a tax cut is a stimulus as well, because it increases the aggregate demand curve, is going to be necessary to address the short-run effects of a recession. But they argue that when we are booming, we should be paying down the debt as fast as we can. So outlined in this video are going to be the reasons why that more moderate position of deficits are okay in very particular circumstances, such as the COVID pandemic, that we may have to spend more than we collect in taxes so that we can help protect the 1 in 3 restaurants which is permanently closed, and the owners of those restaurants, and the 1 in 6 small businesses which are permanently closed. But that once we get the economy back running again, we should be trying to raise taxes as much as we can, cut government spending so that we can pay back all the debt that we accrued over those years. And so once again in this video, I want to show you why they think that. Now, there are 3 primary reasons why increasing the federal debt may present a cause for concern, according to the theoretical basis which we've been learning so far. And so these 3 reasons are that an increasing federal debt may lead to a decrease in consumption, a decrease in investment, or a deepening of the trade deficit. And as we remember from our discussion of GDP, GDP is going to be equal to C plus I plus G plus X minus M. And we can distribute this negative sign in this last term differently, or we can just rearrange those terms so that we have y equals C plus I plus G minus M plus X. And then we can factor out a negative out of those last 2 terms. We get y equals C plus I plus G. We say minus M plus X. And then we can distribute that negative sign. So we have y equals C plus I plus G plus, whoops, let's back up a step there. This is actually where we want to wind up. So we'd have C plus I plus G minus M minus X. So when we would distribute that negative sign, we would have that first equation. So as we can see here, if we decrease I, or we decrease C, then we're clearly going to decrease Y as well. And if this last term, if the trade deficit, if the difference between what we import and what we export increases, then we're also going to decrease GDP. And so all of these reasons are the potential causes of concern for the impact of the national debt on our economic growth. Now, the underlying model, which is going to help predict and form the basis for this interpretation, is going to be the national savings and investment identity. And so this equation is going to assert that the supply of financial capital needs to equal the demand for financial capital, or in fact, not that it needs to equal, that it does equal the demand for financial capital. And so on the supply side, we have savings. So just as we remember in our financial capital models where we have interest rates as the price, quantity of loanable funds, increasing supply, decreasing demand, the supply was made up of savers and the demand was made up of investors. However, now we're going to add two more sectors to this equation. We're going to have another set of demand being the government. And so government spending minus taxes, however much more the government spends than it collects in taxes, we're going to say that it demands from the pool of financial capital, that it's essentially taking loans just as businesses take investment loans for plant and equipment, and that the supply of capital can also be accounted for with our trade deficit. And so we're going to think of the trade deficit as being the supply of foreign capital, which is equal to the trade deficit, which just basically implies that there are more dollars in foreign accounts. So that when we import more than we export, then we are paying for those imports with goods, with US dollars. And those US dollars then sit in bank accounts of foreign economic agents, which then use them to buy US-backed bonds and government debt. Now we can rearrange this equation so that it tells us something interesting. So let's just switch the sides here, because I think that's going to make it more clear what it looks like. So we're going to have G minus T plus I is going to equal S plus M minus X. So same equation as before, but now we're going to subtract I from both sides. And we're going to wind up with G minus T is going to equal S plus M minus X minus I. So what we could do now would be to apply some sort of calculus and take the comparative statics. You do not need calculus for this course, but going forward, if you would continue in your education in economics and business, you will end up needing to take calculus, and you'll be able to apply it in a situation like this to see how variables on one side of the equation change when variables on the other side of the equation change. But in this model, it's relatively simple. We're just going to look for the signs. And so we've been doing this for the last couple weeks with our GDP equation, but now we can see that when the left-hand side of the equation increases, meaning that we're spending more in government spending, we're collecting in taxes, then that means that either savings needs to increase, which would mean that consumption decreases, right? Marginal propensity to consume plus the marginal propensity to save equals 1. There's two things we can do with our money. We can save it or spend it. And so if we're saving more, we're going to be spending less. It could mean that our trade deficit is going to increase, which would mean that X minus M is going to decrease. So we are decreasing our GDP by spending more on foreign goods and services than foreign economic agents are spending on our goods and services that we produce. Or it's going to cause business investment to go down. And so we know that that's part of GDP, so that's going to be bad as well. Now the question is going to be, what ties all of these three together? What's the mechanism which would lead to either a decrease in investment, an increase in savings, or a worsening of the trade deficit? So really, this is just a simple supply and demand story. As you could guess from this equation representing the supply of financial capital and the demand for financial capital. But when we remember that this right-hand side over here is the demand, and this is the supply, then if we are increasing part of the demand, then we're increasing the demand curve, D0 to D1, which causes interest rates to increase as well. And as we remember from our monetary policy discussion and our supply and demand stories from the first third of the class, when we have an increase in interest rates, we're going to have a decrease in consumption and a decrease in business investment as well. And we're going to see a new spin on this. It's going to show that it's going to make, when interest rates increase, it's going to make the US dollar look more attractive for foreign financial capital, which is going to strengthen the dollar, which is going to then make our exports less competitive. So we're going to look at these one by one in the slides to come here. So let's look at business investment first. So as we can see in this image from the textbook, which only goes to the year 2015, we can see two lines, the dashed pink line at the top and the solid blue line at the bottom. So the dashed pink line represents private investment. The solid blue line represents budget deficits and surpluses. And that the lower they go, the deeper the deficit, the larger the imbalance between government spending and taxes. And we can actually see that there was a period of time in the late 90s, early 2000s, basically the dot-com boom, where we were running government surpluses. And as we've mentioned earlier in this class, in the 2000 elections, a big presidential debate question was, what are you going to do with the budget surplus that we're running? And, you know, candidates would say, we're either going to pay down the national debt or we're going to cut taxes or something like that. But that just goes to show, you know, how rare that's been. We definitely haven't done it any time in the past 7 or 8 years either. So it's important to note that these two lines are moving in concert, that when the government deficit gets worse, when the relationship between government spending and taxes tilts more in the direction of more government spending than taxes, we also notice a decrease in investment. When we start collecting more in tax revenue than we were previously, or spending less, then investment increases as well. And we can basically notice, you know, these patterns moving in the same direction, these lines moving in the same direction. So it's important to note here that this bottom line captures the relationship of T minus G. And we know that when G minus T goes up, then business investment should go down in this model. However, when T minus G, since we're just flipping these signs, when T minus G goes up, then investment would trend in the other direction, which would mean that investment would go up as well. So all that we're doing here is flipping the order of these two variables, which then flips this sign, which is what we would expect here based on this model. So once again, the model underlying this, the mechanism underlying this relationship is going to be the rising interest rates in financial capital markets. And so we can see that because government spending minus taxation increases, then we have an increase in demand, which causes interest rates to rise. And if we were to look at the, say, private market for financial capital, then we see the upward sloping supply curve, downward sloping demand curve, quantity of financial assets, and the interest rate. And we know that when there's an increase in the price, that's going to cause one of two changes, or actually probably both. We're going to have an increase in quantity supplied, so more people saving, and we're going to have a decrease in quantity demanded. And since investment and loans are going to be the demand here, then we can see that it's pretty clear why we would expect to see a decrease in investment in this model. So looking at the same type of graph now for consumption instead of investment, we notice once again the same types of patterns, that consumption goes down when our deficits deepen, consumption goes up when the deficits are decreasing, and this pattern seems to generally hold. And this is what we think of as representing, along with the impact on investment, the crowding out effect. That by spending more and by increasing our national debt, by running larger deficits, the concern would be that we aren't really increasing our GDP simply by increasing government spending, because that shows up as one of the right-hand side variables in GDP as well, but rather, at best, we're having no net effect on GDP, because that increase in government spending is made up for with a decrease in investment or with consumption. Now, the second point here is that of the Ricardian equivalence that we discussed towards the end of our conversation on fiscal policy. And remember, this concept suggests that fiscal policy is likely to be counterproductive or unproductive because hyper-rational household is going to recognize that, well, eventually we're going to need to balance the budget. If they're spending more in government spending right now, then that means they're going to collect more in taxes in the future. So I better start saving more now, because eventually the government's going to tax me back for that stimulus check they wrote to everybody. So I'm not actually going to spend my stimulus check. So once again, evidence for that is really weak. Especially, after the stimulus checks of 2020, we saw that 30% of it was spent within 10 days. And, even looking at this graph, taking the data for what it is, do we really think that the reason why consumption went down around, 2008, around the Great Recession, was because that we were running larger deficits? So no, first of all, it was consumption was going down. People were saving more before then, slightly before then. But in general, people were saving more because they didn't know if they were going to lose their job, or if we were going to have this, recession just spiral into a depression, and you were going to need to, you were going to be out of work for a long period of time, or that prices were going to take some unpredicted path. So you can come up with a model to support about anything if you want, but the evidence, especially the recent evidence supporting the Ricardian equivalence, is weak and or lacking. So the last possible cause for concern is a deepening of the trade deficit. And so the intuition here is more or less the same, that higher interest rates are going to make investment in US-backed assets more desirable. That is going to give us an advantage in these financial capital markets, because instead of being able to earn 2% interest on investment in another currency, you could come to the U.S. and earn a greater percent rate of return on your investment in U.S.-backed bonds. So the exchange rate is going to look very similar to what we typically have on the vertical axis in these financial capital markets, which are interest rates. But in this case, it's going to be the exchange rate, which is essentially just the relative price of dollars to another currency, in this case euros. So it may be helpful to think of this as yuan as well, yuan if we're thinking about China. And so as you can see here in this model, or in this just graph, this basic depiction, we're starting off from a situation in which there are 0.9 euros per dollar, And when the price increases, it goes to 1.05 euros per dollar. We could just throw some other numbers on here to make it a little bit easier, that if China is buying US-backed debt, or if they're devaluing their currency, then maybe it goes from 5 won per dollar to 7 won per dollar. And so the US dollar then is, instead of being worth 5 won, it's worth 7. So you can just think of this as being a stronger US dollar. And so we can see that when the United States increases its, when interest rates increase in the US, not only do we see an increase in the demand for US-backed dollars or US-denominated assets, but we see a decrease in the supply. In other words, countries are going to be less willing to part with US dollars because they're increasing in value. And so we get that kind of double effect there, the double impact of an increase in demand, decrease in supply, which is going to have that upward pressure on equilibrium and cause us to have a higher exchange rate with regard to these other countries, which makes our exports less competitive with the rest of the world. So as we'll discuss in later videos, because a stronger dollar means more investment in the United States, it's not exactly clear that that's a bad thing. So the bigger concern is going to be scaring away investment through defaulting on our national debt payments or potential defaults, and scaring away investment through inflation. So just as a quick summary here for the impact of a deepening trade deficit and a stronger US dollar accompanying that trade deficit on different economic agents, see that a US exporting firm would want there to be a weaker dollar and would not want there to be a stronger dollar because it makes their exports less competitive when the dollar is stronger. A foreign firm exporting to the US wants us to have a strong dollar so that we can buy more of their goods. A US tourist abroad wants us to have a strong dollar so that, I don't know if any of you remember that, I guess now it's an old movie, Euro Trip, where it's like high schoolers just graduating before they go off to college. They go over to, I think it's Slovakia. I think they're over in my fatherland, my dad's side of the family's, their home country. And they're in Bratislava and they have like 27 cents in their pocket. Like, what can this get us? We're almost out of money. And they just get this, extravagant hotel and waiters and everything like that. So when there's when there's a stronger US dollar, a US tourist in a foreign country is going to be better off. A foreign tourist in the United States is going to be worse off. So they're going to want a weaker dollar. A US investor abroad is going to want a weaker dollar as well. And a foreign investor in the United States is going to want a stronger dollar, just as we just described. Now, lastly, I think the book does a good job hedging their bets, in that what we've seen so far is the model for why more debt would be bad for growth. However, remember that because we're a social science, we need data as well. And the historical graphs, which we've seen so far, provide some potential evidence. However, we must be very careful not to confuse correlation with causation. So to quote the book here, we're saying that or the book notes that it is also important to acknowledge the direction of causality. Does high debt cause slow growth, or does slow growth cause high debt, or both high debt and slow growth result of a third factor? In the analysis in the book, they've argued simply that high debt causes slow growth, and they note that there may be more to this debate than we have space to discuss here. And I'm just going to cross this out and say there is obviously more to that debate than they have space to discuss. So we don't want to mistake correlation for causation. And in some of the videos to come, we're going to actually provide the basis for why slow growth may actually cause greater debt, or why they may be the result of a third factor. So in this next video, we're going to consider some of the limitations to the data which has been used to support this theory, and we're going to provide some more context for what happens when governments go about trying to reduce their national debt.